Well, I'm joined by the co-manager of BlackRock's $12 billion World Mining Fund. She's Catherine Royal. Catherine, thank you so much for coming in.
Thank you.
In terms of this sell-off or this correction that we're talking about, it's really unclear what's going on. How do you explain it?
Well, there are a number of factors. In relation to the precious metal prices, you've got nervousness over what the central banks in Europe are going to do with the news that Cyprus might sell. You've got fears that quantitative easing in the US might end towards the end of the year. For the industrial commodities, it's more about growth in China. So the data that came through on Sunday night, Monday morning, showed that while China is still growing, it's not growing quite as fast as the market would like.
Were you disappointed with the China numbers, and does it have an impact on where you see the prices of a lot of these raw materials going?
Well, I think it's in our expectation that this year is going to be softer than previous years as a result of a more balanced supply and demand situation. But we see prices well supported at current levels given the cost of production that's out there. So iron ore, when you talked about Rio Tinto, is a prime example of that, where prices have stayed up at about $140 a tonne, beating market expectations. So there is already built into expectations some kind of softening this year, and it's more about cash flow generation and volume growth for these mining companies. So there's still a lot of potential to surprise on the upside for these companies as long as they deliver. Because they haven't really been part of this rally in terms of valuations on the mining companies. We've seen a lot of changes at the top, chief executives leaving. Do you think that they'll be better valued in the coming quarters as we start seeing adjustments? Well, these results are incredibly important because it's all about whether or not we see this free cash flow generation coming through for the industry. Prices are at historically high levels, not as high as they were, but still quite high. So it's up to the company management teams now to show the market that they can generate these free cash flows and give them back to shareholders. Catherine, is there something that actually you think investors aren't really seeing at the moment? We talk about further corrections, we talk about possible, QE being unwind much sooner. When you look at this industry, is there anything that the market is either mispricing or not understanding correctly? No, I think the market is pretty pessimistic at the moment. So its expectation is that growth in China is at that 7 to 8% level. Its expectation is that US growth will come through, but even then it's still a bit nervous. And its expectation is that commodity prices are going to be range bound. So now the way to deliver for these mining companies, the way for their share prices to perform, is to show that through volume growth, through cost control, they can generate those cash flows. And you were saying that actually the markets are pretty much spot on, maybe a little bit more pessimistic than you are. First of all, just give me a sense of how investors can take advantage of this industry. What are the commodities, what are the materials that you think will outperform the others over the next couple of years? Okay, so what we're looking for are those commodities where you've got cost curve support, so where there are high cost producers that are supporting the price at current levels, and so you then get exposed to the guys that are the leading producers. So Rio Tinto would be a good example of a low-cost iron ore producer supported by domestic high-cost Chinese production. And then also what we're looking for is the tangible evidence of delivery. So looking over the last 12 months, seeing the change in rhetoric, but then actually going through the numbers, seeing whether you've had headcount cost cutting, whether you've got changes in the way they're operating, the decisions that they're making, and beginning to try and get a track record for delivery, so that when we look at the next 3 years, we can say, well, margins are going to be strong in those commodities, and they're actually going to do what they say they're going to do. Yeah, that would be ideal. Copper looks pretty attractive at the moment. Would that be your favorite play? I think at the moment, yes. I think when we're talking about the commodities we like, we're looking more on a 3-year view. So there is some concern at the moment about inventory levels and how they've increased recently. But in terms of new supply coming online over the next couple of years, yes, this year's in balance, but when we look at the year after that, we're just not seeing where that supply is going to come from. And also in terms of Chinese demand, even if you think the economy is maturing, you're still going to need a lot of copper for electrification, for white goods, for electric cars, for wind turbines. All of these things make copper one of those commodities where demand looks really quite good. What about platinum? I mean, this is a vastly different, of course, metal used in all kinds of smaller things, I guess, than copper is. Well, platinum's interesting because sort of around 60% of its industry, auto catalysts for cars, and then the rest of it's precious metal-like. It moves with the gold price, jewelry, exactly. I think from our point of view, platinum is interesting, and also palladium, which is like its sister metal, is interesting because of of the supply constraints that we're seeing coming out of South Africa. So there's very little growth as a result of the structural problems, whether it's wage inflation, aging mines, the strikes that we saw last year. But also you've got, for palladium, for example, the Russians aren't exporting palladium in the way they had in the past. So you have a real sort of supply-demand balance that looks very interesting. Demand, although muted, is growing, particularly out of China, and now the US recovery suggests car buying in the US should be more positive going forward. And so there's actually a really good dynamic when you look at the next 3 to 5 years as to the way those prices could evolve.
Catherine, before the break, we're also talking a little bit about gold and this 14% sell-off that we saw over the last 2 days. It is recovering a little bit today, but what are your expectations in the longer term for gold?
Well, gold's interesting because there are so many drivers and it's very complex. I think one of the big challenges this year is the lack of inflation and the fact that we think QE might come to an end in the US. But longer term, when you look at the kind of decisions that are being made by governments, it's all about stimulus. It's all about trying to get economies to grow, and they're desperate to avoid deflation. So for us, the probability of inflation over the next 5 years is higher, not lower, than it was last year, for example. And other things such as cash losing your money, the Cyprus event of savings being targeted, means people are looking for alternatives. And when you look at those sort of broader views, you step back, and actually the outlook for gold for us is really positive over the long term.
Even if there's this concern that maybe central banks may be forced to sell some of their gold?
Well, you've got to put that in perspective. So there's a European Central Bank gold agreement that limits sales per annum to 400 tons. So that's the sort of maximum you can expect per annum. Cyprus has 14 tons. So yes, there's this risk that maybe Italy, Spain, Portugal could start selling, and that's what's scaring the market. But you've just got to put it in perspective, and at the moment the moves we've had over the last 2 days, they're completely out of perspective, and that's more of a panic event rather than something fundamental.
Catherine, talk to me a little bit about what it means being a chief executive of one of these big mining companies today. There's been a lot of shareholder activism in terms of the M&A that they've done in the past. What in your eyes would be the ideal chief executive, or how do they have to move in this kind of difficult environment?
Well, the ideal executive looks at their mining company as a business. So it looks at where the best returns can be generated. And that's not always building, it's not always M&A, and sometimes it's buying your shares back. But it's not that one or other is the right way to go or the wrong way to go. It's that you look at all three and you say, where can I get the best returns for my shareholders? Now, you need to build new mines as a mining company, otherwise you run out of ore. Occasionally you need to acquire assets because they're not necessarily discovering new large-scale assets. Other companies might be doing that. But it's more about putting it in a line with all three and saying, where can I get the best returns? That's what a good chief executive should do.
We've had these huge mega M&A deals over the last 10 years. Is it going to temper off because CEOs realize that this may not be a right strategy, or is it just because actually there are not enough entities to be acquired out there?
Well, we would hope it would temper off because it's not the right strategy. I think you're right. There's been a lot of consolidation in the industry, so the ability to acquire and add value is much more limited than it was in the past. But from our point of view, if they need to make acquisitions, it's got to be because it adds value, because there's upside, because there's good returns. It's not about just bigger is better.
Catherine, thank you so much for that. It was great speaking to you. BlackRock Fund Manager Catherine Rowe there.